I'm Melanie Wright, and I'm the money editor at Restless. And I'm here today to talk to Nishma Waite about pension tax-free cash. And Nishma is a chartered financial planner at Fidelius. I wanted to find out, first of all, just briefly what the tax-free pension rules are. So how much can you take out of your pension tax-free and at what stage?
Under the current rules, you can take out 25% tax-free lump sum of whatever your pension is valued at. There is a cap which has recently been introduced, which is 25% of the lifetime allowance, which is currently £268,275. Now you can take this from age 55 under the current rules as well.
Fantastic, thank you. And obviously there's always lots of speculation that pension rules might change. Would you suggest that people take their tax-free cash sooner rather than later?
It's a question that's a very popular one at the moment, and I'm being asked that quite a lot. The first thing I would say is that there is no hard and fast rule on this. It really depends on an individual's personal circumstances. Different things will apply to different people based on their objectives and goals, their retirement plans, how much money they've got in their pensions, when they need it, whether they're relying on it. There's so many different factors that take play in this, so it's not one rule for everyone. One thing I do say is that if you do need the money, it's worth considering and taking advice on. Again, you do need to sit down with someone to look at your overall situation to make sure that it's appropriate. But if you don't need the money and and it's there and you're just concerned, again, I would say take advice on it. It's something that really needs to be looked at along with everything else in your life, really, to see if it's appropriate.
Are there specific downsides to taking the pension tax-free cash early?
Yeah, there are a few downsides. And again, it's down to individual circumstances. But I'd say probably the generic downsides are that you're taking the money out of a tax-free environment. So within the pension, you're not paying any capital gains tax, any income tax, and if you take it out of that, then you're putting it into a potentially taxable environment. Also, whilst it's in your pension, it's invested if you have got it invested in investment funds, and by taking it out, you're missing out on potential growth that would be tax efficient growth as well. But then I would say the big one really is that you're taking it out of your pension and putting it potentially in your bank account where you can see it and access it. So there is that temptation to spend, and maybe spend a lot sooner than you intended. So, people set out retirement plans, and the idea is for the pension to, provide them with an income in retirement for life. If you've got that money sat there in your bank account, it may be that you spend it a lot sooner than you wanted to, and you run out of your retirement funds a lot sooner. So I'd say that was probably the big risk.
Very good point. Thank you, Nishma. Thank you for spending the time to talk to us.
No worries. Thank you. Bye.